Good evening. This is Tom Alexander. This is a special stock market report. It is Wednesday, January 8th. It's in the evening about 6:15 p.m. Eastern Time in beautiful Charleston, South Carolina. The stock indices are just above major inflection points. I sent out a bulletin to members today. We're going to get a significant move away from here, and I think it's going to be very soon. We're in the new year now, and I wanted to do this special report. I think I didn't want to wait until this weekend. Now, U.S. markets are closed tomorrow, Thursday. They're closed all day. They open again on Friday, so there's no trading in the U.S. stock indices tomorrow. In the cash markets, the futures markets start back up in Globex at 6 p.m. But let's move over and take a look at some of the charts here and some of the important information that I think we want to be paying attention to. Okay, first and foremost, here are the four primary U.S. trading indices: the SPX, the NDX, the Russell, and the Dow. Now, I have highlighted on the screen here the critical downside levels. Something else I want to make note of here. I talked all last year about the out of syncness of the indices with one another, and just all over the place. They were not consistently in the same structural position, and now they are. They didn't get here the same way, but they are here now, and they are in the same structural position. They are all basically in balance areas. They are all off of their all-time highs to one degree or another, and they are perched on critical downside levels. I don't like to use the term support. They are inflection levels. I think you're going to get a sharp move away from here. I think it's going to be down, and I'll tell you why I think it's going to be down, and I want to qualify that. I'm wrong if we have big wide range up days in all of the indices and breadth has this big expansion. I'm wrong. So that would be what would invalidate my current working assumption, which is a bearish assumption. I think that these levels are going to be taken out before we go ripping above the high put in on Monday. Okay. So that's the level to the upside that we'll be keeping an eye on. Now, you can see we're in balance areas in all four of these indices. By the way, I would very much appreciate it if you find value in this, if you will like it, if you will subscribe. Also, uh, just a note, I did a special report back in the middle of December when we were putting in this spike low. And that's in the email that I sent that each of you should have received. If you did not receive that email and you want to get my emails, I do not sell email. I don't spam you. I just send notices when I do special reports like this. These are free. But if you're not on my list, you can get on my list by sending me an email to tom@alexandertrading.com. Okay. But anyway, so if you got that email, in that email, I put a link to the report that I did in the middle of December. And at that time, I said we were very, very, what I felt like we were very, very close to an important short-term low. That indeed occurred. Now, what's interesting, and this is why this is another reason I have a bearish perspective at the moment. We had this spike low, and then we had the huge bungee jump rally, and it basically failed, and we tested that low to varying degrees. Then we had another attempt at a spike higher. That didn't take out the previous high. So typically in this bull market that we've been in since at least October 2023, I won't argue, you can go back a lot farther than that if you like, but at least since October 2023, when we put in these lows, the market has traded sharply away from them and stayed away from them. Well, that hasn't happened so far this time. That's why I think that something may be brewing that's different this time. Now, I want to show the profile view. Now, this is a profile perspective of the S&P. Excuse me. Each letter represents 1 month of trading. I mean, each letter represents 1 day of trading. Each profile unit is 1 month of trading. And if we go back to, again, to October of 2023, this is where the market bottomed. Now, this is the low, right? This is the close, okay? And since this close, I want you to notice now there's been a steady migration of value higher in the indices. And you can see that two ways. You can see these nodes, these volume nodes on the horizontal scale here continue to make higher highs, higher highs. You can also see the closes of each month higher, 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 higher. We had a bit of a blip to the downside here in April of last year, and then we went higher, 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 higher. Well, you can see. Let's see, where is this? Where's this close? All right, this was lower back in October of this year, but then we bungee jumped higher to new all-time highs. But since then, we've closed lower. Now, if we were to take this level out here and we continue lower, that would be, and we close this month below the close of last month. That will be the first time we have had two consecutive monthly closes since way back in October of 2023. So that's something else to keep an eye on here. If we go down in time frame, which I'll do, I'm going to just go to a 60-minute profile. I think. Let's see. Why are you not coming up? Let's see. Why will it not show up? Let's give it a minute. If we don't get it to come up, we'll just move along. What I wanted to show you is a more granular view of this balance area, this very clear balance area. Let's go back to the daily. But you can see this almost perfect Gaussian shape of the trade so far in the month of January. We're closed right at the midpoint. So you've got this ledge right here that's critical, and you can see it most clearly on the bar charts. And you've got this gap in here. So if we do trade lower on Friday, we have some sort of dramatic down day, this level will come out. Now we don't have to, it doesn't have to be on Friday, but I think as long as we don't see this big sudden expansion in breadth that is accompanied by wide range days in all four of the indices, we could trade around in this area, okay, before we take this out. But unless we see that big expansion in breadth and all four of the indices take out this week's high, I have a bearish working assumption. Another reason I have that bearish working assumption is from the technical information. Now, VIX has been sort of stubborn, hanging around here, this plus 16 area. It is in a position, it's not going to hang around here for long. It's either going to spike higher or it's going to come in sharply. So volatility is about to expand or contract dramatically. And it's a chicken or an egg thing. If price goes up, VIX is going to drop. If price goes down, VIX is going to expand. And then finally, last but not least, breadth, NYSE data. Now, breadth has been, the histogram down here is closing breadth. The red line is 10-day moving average of NYSE advancing issues. The green is the 5-day moving average of advancing issues. You can see we're nowhere near extreme to the downside. We have not had anything resembling an extreme in breadth. And an extreme in breadth is something negative 1,500 or lower. preferably negative 2,000. If we do have a bearish resolution, I'll be surprised if we don't see that negative 2,000. If we see that negative 2,000, then we have some really good information, and I'll probably do another update at that point in time. But there's plenty of room. The 10-day and the 5-day moving averages of NYSE advancing issues look like they're rolling over. So we'll see. Now, again, I'm wrong a lot, which is fine. I know when I'm wrong, and I'll be wrong again. If we get a big expansion in breadth and we have wide range days and all four of the indices take out this week's highs. Hope you guys have found this helpful. I'll speak with you again soon. Have a good evening, and we'll see what happens on Friday. Enjoy your holiday tomorrow.